right, all right, all right. Good morning, everybody. I've been waiting for this one, Johnny. I've been waiting for this one for a long time. Good morning, Johnny Walkup. How you doing?
I'm doing all right. Good morning to you, Noah.
Noam?
Good morning, guys.
Newman? Thank you guys for joining us today, especially you, Noam. I appreciate it.
How you doing? My pleasure. It's my pleasure.
This is like an annual thing that we're going to be doing, right? I think.
I look forward to it. If I'm invited back, I will, graciously accept.
No, I truly appreciate it. Rarely do we have you on, but you're one of those high quality, just do it once a year and people need to see it and they need to understand what's going on. I feel like there is a 30,000 foot view narrative that is taking shape right now that is so critically important. And I feel like all of us agents and all the clients, we're just so exhausted from the last decade that we're not seeing it. A lot of agents aren't seeing, they're just in it. They're too in the weeds. They're not seeing the forest for the trees, so to speak.
There's a lot of chaos right now. And I'm not in the weeds. I mean, the agents really do the hard work. I'm not in the weeds, but I see the chaos and, I appreciate the opportunity to discuss it.
Yeah, well, we're going to discuss it, guys. Let's get going, guys. That is John Walkup right over there. I am Noah Rosenblatt. We're both at UrbanDigs, and that is Noam Newman, CRE owner and operator. And for those of you that don't know, Noam was on our show about a year ago. Was it last May or last June? Noam?
Last May. Oh, so there was a question for Noam. I'm just going to jump in right there. Last May.
Go ahead, John. Whatever you want to do, you can come in whenever you want. It was last May, and for those of you that listened to what Noam was saying, if you listened to what he was saying and you understood it, and then you explain this to your clients right now, fast forward 1 year later, you're a rock star. You are looking like a complete rock star. So Noam, I want to just show a recap. I'm going to start out today by showing a clip of what you said a year ago that kind of has taken shape and has transformed and explains where we are today. So let's put it up.
I'm just trying to put all the pieces of the puzzle here. If the rental market starts to do parabolic things, and what happened in April with that bump up is just the beginning.
That's just
we're going to see consistent rises. Like we could be at a median of 5,500 rents by this time next year if what you're saying is playing out.
Right.
What's the trickle down? What happens? Walk me through how the whole cycle happens. Who starts noticing on the outside? Investors, developers. How does this all play out?
So the rents go up, and all of a sudden, the thesis to go ahead and build something comes back into play, right? So the rents go up, the cost of capital stabilizes, the cost of material stabilizes, the business environment stabilizes, and laying out a business plan to build something or produce new housing on any level starts to make a little bit more sense. But for that to occur, I mean, that's like moving an aircraft carrier, right? It doesn't occur overnight, right? A lot of things have to fall into place. So everything is functioning off of existing inventory, right? So in 12 to 24 months from now, the rents are going to be at this new level. And then a decision will be made on those market conditions to then produce more housing.
Okay. That was a year ago.
That was a year ago.
And for those of you that didn't see that, there was 45 minutes of us explaining your whole thesis into that whole thing. I believe rents back then were about 47, 48. It was just under 5,000, something like that. We're approaching record highs.
Right.
And the target you give was 5,500. We're probably at that level, if not higher right now. So
I think there was an article that hit May 15th to the day, wasn't it? That I think there was an article in the Post.
Whoops. Let's go see if I can find it. Was it this one? There it is.
There it is, 1 year to the day.
Unbelievable. So I just want to say, first off, an amazing call. You explained why it was all going to happen very, very clearly. It was math. It was just math of what's going on. That's what people don't understand. It's like this. You see it clearly. A lot of us don't see it clearly. So I want to ask you now 1 year later, now that your thesis, which your original thesis in 2025 was a 2 to 3 year thesis, something along those lines. I think you mentioned 27 as like your kind of minimal point.
Yeah, so I think we bracketed as 12 to 24 months from the original podcast.
Okay, so now we're about 13 months in. And
right.
So far, everything you said is happening out there, like scarily happening. So what has changed? What has not changed? Where are we in this baseball cycle?
Okay, so we're now the rent narrative is out of the bag, right? This is now, mainstream. So what I believe the sentiment was last year is that you did not have urgency. And now we're shifting into a period where you are starting to gain urgency, but you don't have the inventory to accommodate that urgency. So the relationship, that's sort of like relationship between and I'm really focusing on the 3 million and under market, right? Anything, because people 3 million and under, those are the people who make New York move, right? Every day. So if you're looking at the 3 million and under market and you're looking at the rents right now, they're fighting with each other. And that's what I'm observing. That's where we are currently. So you have expectations that are in this previous part of the cycle, and then we are transitioning into an area where a new cycle will begin, but we are not there yet.
So it's interesting, because it's really interesting to watch how this has been playing out. And really, right, the core of the thesis is really that this is a much more about supply versus demand. At the same time, though, one of the things that we're seeing in the back end is the craziness happening with mortgage rates. They were up at like 7%, they're down to 6%, out of 6.5%. And I'm wondering, especially since you're talking about that under the 3 million market, how much do those sort of factor into this thesis right now? Because it almost seems like those are sort of a sideshow at this point, just because the structural dynamics are really what's driving this market.
I don't think rates have anything to do with this discussion.
Huh.
Right. Unless we're discussing rates going to 10% or going to 2%, it doesn't matter. I think the rates are where they are for a multitude of reasons that, we could spend 2 hours just discussing that, but I don't think rates have anything to do with this. You shop for the best mortgage rate that you can get, whether it's a 30-year fixed or a 5/7 ARM or a 10/1 ARM or whatever your sort of product of choice is, and that's it, right? It has nothing to do with what's happening out there.
I think that's an amazing, I know you got to follow, but I think that's an amazing distinction, because so much of the conversation is dominated by, especially in that non-luxury sector, whatever you want to call it, that the meat and potatoes of the market is dominated by like, what are rates? And I think the conversation for the longest period of time has been like, oh, well, rates are up, so the market's slow. And what you're saying actually dovetails with a lot of the research we've done in the past, which is that the correlation between low rates and high contract activity is a lot weaker than people think. And what you really, really want is more of a stable environment. It's not about the level of rates, it's more about the stability. So I think we're sort of, to your point, I think we're sort of in that stable environment now. I'm going to touch wood on that. Sure. But it's interesting. So you have that stable environment as the background, which sort of negates the rate conversation and focuses it back on the structural conversation. Super interesting.
Yeah, this is a cost. The issue is cost and affordability more so than it is rates. So yes, I agree with you. Yeah.
No, I want to stick to the rental market just for a second, and then I want to talk about the commercial market. But let's just anchor to the rental market for a couple of seconds. What put us in this position with the rental market?
Okay, so we had the 2019 regulations. Those 2019.
That was the key one, right? That was the biggie.
That was the biggie, right? So that all of a sudden took the burden, put the burden all on the free market, right? Because the motivation to operate within the rent stabilized market on any sort of mainstream investment level was essentially gone. Your equity in that is gone. Those landlords are hurting, and it's sort of not good. So you have now all of these rent stabilized units being warehoused, or they're not producing what they're supposed to produce. So the free market is now bearing the burden of all of the rental demand, whether it's individual condo owners who rent out their units or free market rental buildings. And those two buckets are in very sort of constrained supply, right? So they're right now dictating what the price is because they have no competition. If they do have competition, it's very, very thin.
Okay. And here's guys, I just want to put a quote up here. Gary Mallon, Gary Mallon over at Corcoran, he's just super smart, and he just knows the rental market like very, very, very well. Here's what he said in a recent article, and I highlighted this. He points first to the 2019 rent law reforms, which he argues gutted landlords' ability to recoup renovation costs on existing apartments, leaving thousands of units sitting empty because bringing them back online simply doesn't pencil out. That echoes exactly what you just said. And now we're 7 years later. I mean, it wasn't the intention of the policymakers to put us in this situation, because the situation is not favoring renters. They did a law to favor renters, but it created an environment that doesn't favor renters. And now when you look at this, Manhattan renters are getting walloped, and those median rent figures are just surging, and inventory and new leases are surging, but inventory is shrinking. So my question to you is, you said a while ago that the rental market, residential rental market, and the commercial market, rental market, those are leading indicators of our market.
Correct, because, and I look at commercial real estate activity only as with a very broad stroke. But if you take a look at some of the articles that you and I sort of shared with each other, there's 2 Park Avenue that's reaching 90%.
Whoops, not that one. I got it somewhere here. There you go. It's hard to keep track. Yeah.
Right. That's okay. And then the what's the other one? There's a record-breaking price at the at one on West 57th, I believe. That was another one. So when I take a look at that, I say, all right, well, that means that the jobs are back, right? And what kinds of jobs are coming back, right? Well, they're not low-paying jobs; they're very high-paying jobs, right? I mean, this is healthcare, consulting, finance, AI, technology, whatever you want to call it, right? These people get compensated very, very well, right? So jobs equals high salaries equals high rents equals rental exhaustion, and that's the way I'm connecting it.
Go ahead, Johnny.
No, I was going to say, so that the commercial renaissance in the city post COVID, I mean, it was one of these things that was like slowly, and then all at once. I mean, it was, several years of like, oh my gosh, people are bringing back buildings, but ground floor retail still doing not very well. You're having the stories about these empty buildings. Suddenly, obviously the Class A was filling up and doing very well, and now you're start to seeing it filter through. And I'm just curious, in your opinion, how that momentum, how much of the momentum is really responsible for, filters through to the thesis. In other words, if this was a steady build, would you still see the same pressures building, or is that just sheer momentum of just going from okay to fantastic in the span of like a year? How much does that influence the thinking here?
I think it's adding to the pressure, right? So right now was the frog in the pot, something like that, right? It's adding. The pressure is building. The pressure is building, right?
Slowly boiling the frog. Is that what you're talking about?
Yes. Thank you, John. No, I appreciate it. It'll just continue to create a scenario where renting is going to become more and more and more frustrating, right? And there it is. Right. I mean, that's a record-breaking price per square foot. Right. And
9 West 57th.
I'm in no position to challenge the Real Deal's data. Right. So when you look at that and you look at the type of tenant that will be coming into New York City in order to conduct business, even if it's a few days a week, it just makes sense. Right. That these people are going to have to find a place to live, even if it's part-time. Yeah.
And with that, I just want to pause going quickly. So guys, we have the comments enabled, so feel free if you got a question, comment, etc. If you want to just put Noam on the spot, we totally welcome it. Ask him.
Ask a lot of questions.
Yeah. Anyway, so Michael writes, but isn't the rent stabilized market so much different than the 3 million buyer segment with all of those new high-paying jobs?
You are 100% correct. Those are 2 very, very different types of tenants. But if we're looking at it broadly, you're looking at the inventory as a whole. Right. So if you're taking rent stabilized units offline, that means you have less apartments to rent in general, which means that pressure is going to shift over to the free market, and it's going to crowd out people at the bottom. So that bottom is going to start rising, I should say.
So
Yeah. Oh, sorry. Just a quick follow up on that. And this is one of the things that we heard this post-pandemic when the market first started opening up and the rents were really low and the landlords were throwing all kinds of incentives to bring people back into the city. That reversed course pretty quickly in early 2021. And then suddenly the rents just started going up 20, 30%. And one of the things we were hearing was that for landlords with a split portfolio with some rent stabilized and then some free market, it was don't bother with the rent stabilized because that's a nightmare. Instead, make it up on the free rental, the free market. I guess that's still in play then. So if you can't, to Michael's point and to your point, which is that overall pool of inventory, if you're not making anything on the rent stabilized, are you necessarily making it up on the free market side? Are you increasing those rents to compensate for the poor performance on the other side?
If you have a split portfolio, you kind of have to, right? Someone has to, somebody has to do the heavy lifting, and it's going to be the free market. And I'm as a business person, you're just not going to focus on something that doesn't make you a profit, right? You're just going to have to abandon that business plan for a while until the policy allows you to operate appropriately. Otherwise, what's the point?
I got a couple of rapid fire questions real quick. First off, is the mathing right now, or it's still not mathing?
Hard and fast, no. According to some reports, permits are down 28% year over year.
Jesus Christ.
Right. So the type of person or the type of organization that's going to produce housing, what are they going to produce? Right. They have to produce very expensive housing. So if you're taking a look at anything that's under $5 million, under $3 million, whatever your kind of bracket is, then how are you going to produce a new condo in this sort of like achievable price point, so to speak? Right. It's impossible.
So the pipeline of new development right now is not, it's still shrinking, which means there's a 4 or 5 year gap between that starting to go up and inventory starting to actually hit our market, I imagine. I guess forget pre-sales, forget about that kind of stuff, but there's a gap, right? There's 4 or 5 years, something like that, between permits and pre-selling that unit, the development.
That makes sense. And don't forget that just because you have permits and you use that as sort of like a broad term, right? That doesn't necessarily mean that all those units are going to be condos. Some of those are going to be rentals. In fact, the rental thesis makes sense, right? The condo thesis doesn't even make sense yet. So how many for sale buildings are going to go up for sale over the next 5 years? I would imagine it's very, very low.
Right.
You can't really underwrite that unless you're building, unless you're converting the Flatiron building and selling units at $10 million a clip.
So if the rental market, right now, all the pieces of the puzzle continue to say shrinking inventory in the sales market. Yeah. Generally rising rents. Let's not say rising rents because people will get all upset if 1 month it goes down and, they're like, oh, you're wrong. But I mean, generally the trend is up. That's not changing at all. That's still in play, right? That rising channel. Rental market.
So it went parabolic from last year to this year. And this year, I think it'll still go up, but not as aggressively.
Okay, so more of a stair-step pattern. Same thing with the commercial market. That trend's in play. It's booked. The commercial market is just recovering, and that's going to continue to happen, right? You don't see anything that's telling you that that's going to stop. Correct?
I mean, it's not really a policy business-friendly environment at the moment, so I would say that could slow you down, but. People, I mean, New York's a big machine, right? Like people have to like do stuff and earn a living, and it's just I don't see it. I don't see it making wild swings to the upside, but I don't see any downside risk. Not high downside risk, I should say.
Okay. The reason I asked that was to ultimately ask this. I was setting it up, so to speak. I'm already hearing stories of rental exhaustion. That phrase that you discussed that probably is not going to hit until the 24 months, the full cycle kind of matures, which puts you a year from now. I'm already hearing stories and there's videos out there of people saying, you know what, these rents going up crazy. Why don't we consider buying? So is there, in your opinion, is the renter exhaustion that we may be seeing now, is that just a prelude? Is that just a tease of what's kind of happening out there, or is it starting early?
No, I think it's right. I think it's right on time. There is a canary in the coal mine. There was a Real Deal podcast done on 800 Fifth Avenue. I don't know how many of your viewers caught that one, but essentially Naftali is taking over, or has taken over 800 Fifth Avenue. You have a lot of high-end renters there, and they were, the rents there, let's say between 6,000 and 15,000, for example. I mean, those are high rents, and I think we have a few clips of that, if I'm not mistaken.
Well, I have this one right here. I'm going to cue it up really quick.
It's really hard to rent in the Upper East Side. The Upper East Side in general has become a really competitive market for both buying and for renting. And I think actually from talking to brokers who have worked with some of the people that are trying to find a new place to live, multiple of them said their clients were like, well, I've been renting for decades. Like, I want to keep renting. And then after looking at their options, I checked for the story. There were like 20 rentals available on Street Easy in the neighborhood. They were like, I think I actually have to buy.
There's your urgency.
There's that, and then you have this.
I will say, on a personal anecdote, I just had this happen to me, right? I've lived in my apartment for 6 years. My husband and I went to go look at new apartments, and it ultimately has been cheaper for us to buy an apartment, which we are now doing in the same neighborhood, but rather than moving to something new, because even just in the last, half decade, all of the prices around us have gone up so much, and that's in, pretty deep Brooklyn, that the option to buy, maybe the sales market actually becomes better than the rental.
That's what I'm saying. It's starting to happen. So I'm wondering whether or not, is this it? Is this it? Or is it, no, this is not it. This is getting a little tease here. Preview.
That's a tease, because you still have to come up with your down payment. You still have to function within the under $3 million market. And the under $3 million market, you're most likely you're going to get a mortgage, right? Even if you're financing 50% or whatever it is, right? So there's still a delta that people have to push themselves over the edge to that side, but it's close. It's very, very close.
Yeah. Noam, I'd like to take it to the comments for a second. First, but first I want to give credit where credit is due. Noah and I, we've perfected the headphone game here, but I got to say, Real Deal with the mic game, looking good. Good mics on them. All right. Good. Moving to the comments, quick comment from Deborah. What about the holes in the ground on West 57th between 5th and 6th Avenue? And I think I'll just jump in on this one. I think this sort of speaks to your thesis, which is if you're going to develop something, it's got to pencil out. And I think that's why you're seeing these high-end locations where you can have that assemblage and you can turn it into something that's going to pencil out. That seems to me the most likely, but I'm curious on your take on that.
If we're looking at that corridor specifically, that sounds like the Billionaires Row corridor, unless we're doing some sort of subsidized housing product. I don't know which one specifically she's referring to, but again, if you just want to take that thing and turn it into inventory, that's 2030, 2031.
Wow.
Right. So it's not a thing. Right. It doesn't solve today's problem or next year's problem, I should say.
We got another question here from Dale. What would trigger more sellers to list their resale condos if new dev is so weak?
What would trigger? Repeat the question one more time. I'm sorry.
What would trigger more sellers to list their resale condos if new dev is so weak?
What would trigger resellers to? I think it's just sort of like the life cycle of ownership. So statistically speaking, what's ownership, like 5 to 7 years? People are staying longer because of mortgage rates. So I think life just kind of has to dictate that at a certain point.
Yeah.
And
where
I think
are you going to go to?
There is an adjustment. I think there was a downside adjustment in new dev, right? So the delta over the last couple of years between new dev and resale was here, and now it's kind of more competitive now. So if you may be sort of prepared to make that lateral move to something else. I don't know. It's a little nuanced for me.
Okay, interesting question. And we got one more question here is, what is the ratio between rent stabilized and free market rental units in New York City? Do you happen to have any clues on that?
I don't have that stat, and I don't want to misquote. So
okay.
Yeah.
I appreciate that.
Yeah.
Go ahead, Johnny.
Yeah.
All right. So now I'd like to just talk about the next part. We talk about breaking the channel. And I think what I'd like to start off, Noam, is when you talk about the channel, what exactly are we talking about? How do you define the channel, so to speak?
Okay, so we had a period of time of rental malaise, right? Where rents were really not doing much for a long time. That ended. And now we're entering a period where the sales market malaise is going to end, where you're now going to be able to start achieving either recapturing what you originally paid for it, or start to actually make a little bit of a profit, right, on this 10-year sort of flat period, if you will. And essentially what's happening is that I believe that there's an industry-wide expectation complacency when it comes to expecting what the sales market will do. And I think that period is ending.
So I got a clip I'm going to show you, but before I show you the clip, because John and I have been talking about this a lot. I believe deeply in this theory. I think we're about to break this channel, and we talked about it recently on UrbanDigs. I'm going to put it up real quick. This right here represents probably February's market. That's probably February's market right there. So where are we now in May? If you signed a deal today, we got some messages over here that I had 15 people at my open house accepted offer. That's today. That's not this. That's today. Today, good. You're going to get a signed contract in 2 weeks? Great. I'll find out that closing in 3 months. I'll find out that closing in August or September. We'll get public record of that. So where are we right now? I really wonder, are we here and we're still in the channel, or are we here and are we above the channel? Yeah, and that was a month ago. And this market, by the way, this market is hot right now. This in mid-June, we are at our strongest level with contract activity, with supply down 8% year over year. Contract activity now is up 12% year over year. So the market's even hotter now than when we published that about a month ago. And I seriously, if you sign a deal today, we'll find that out in August, September. Are we busting out of the channel as we speak? And if we bust out of the channel, what does that set up? Does that set up a new cycle? Does that create different math? Does that bring the investors back? I mean, because I got to be honest with you, Noam, everyone's given up. There's this exhaustion. Sorry, hold that thought. Everyone has completely given up. Nobody thinks this market's going to go anywhere. Agents are kind of thinking, you don't buy for an investment. You're not going to make a lot of money on this. They got their buyers that they sold to 9 years ago that are selling today, 7, 8, 9 year, 10 cycle selling, and they're not making anything. And they just think it's going to extend. And here we are saying that, guys, you are literally in the batter's box for what's about to be a different upcycle that's going to start over the next 5 to 7 years. But the market doesn't see it that way.
The tectonic plates are shifting. It doesn't happen fast, right? It never does. But I think whatever period of time you have been operating under this, whatever it is, 10-year period, as soon as that channel breaks, that's the new cycle. That's when it begins, right? So that's tip off.
Yeah, no, I think your tectonic plate metaphor is apt because they do not move very, very fast. But when they collide, I mean, that's when you get the mountain ranges, right? So we're starting to see some of that collision early. And I think that the clip that you referenced about 800 Fifth Avenue is, to use it another metaphor, so the tip of the iceberg, right? Just a handful of renters are like, oh, wait a second, this doesn't make sense anymore. And someone else saying, oh yeah, maybe it does make sense to buy. And so you're starting to see a little bit of percolation here and there from flipping sides. And you're right. And to Noah's point, this is the market that we've seen where the spring market kicked off. And instead of the last few years, we've seen a rapid rise into spring and then a quick fall off as that initial wave fades out. We've seen this sustained action, which we haven't seen for years. I think the last one we saw was pandemic, but I mean, that was a different market. Really, you'd have to go back to 2012, almost through 16 to see sort of that same level of spring activity in terms of seasonality. So it's really been, to your point, that decade of malaise, and we're finally starting to get out of it. So, if you think about that channel, you think about breaking that channel. So we got increased rents, we've got lack of inventory pushing up. So is the channel, in your point of view, is it volume and price, or are these things separate from each other?
These things are separate from each other. So I think volume, the industry has gone through a period of consolidation. So volume is sort of, I think, low, going to be low for the foreseeable future, because we're producing less stuff, right? And you're going to start seeing a nice, small but noticeable step up in pricing as there's,
but not volume.
Not volume. No.
When because supply is so much lower and tighter.
Yeah, and when volume comes back, I mean, I have no idea.
Okay,
I wouldn't be able to go that far.
I have a couple of charts to show about breaking the channel, but first I have this chart that kind of zooms in, Noam. This zooms in. I wanted to first show this zooming in and kind of and kind of show you where we are now, and that you could kind of break this up with like 6 pieces if you just work with me from left to right. And again, we're zooming in. We're going to zoom out after this, but first we're zooming in. You got the great financial crisis decline over here, which lasted about a couple of years, 15% year-over-year decline, stuff like that. You got the bottoming base after that, call it 2010 to 2012. You got the upcycle in 2012 to 2015, 16. You got that policy-driven, slow, progressive decline from 16 to kind of the pandemic lows of 20. Okay. You got the post-COVID surge, and then you got this range-bound, slightly ticking higher, and we're kind of at the highs. You could break it up that way, Noam, but when you zoom out, and you look at this from a non-truncated chart point of view, like now the vertical axis on the left is starting at 0 now instead of 900, right? Look at how sideways we have been. We've really only been through 3 cycles in the last 18 years.
Yeah, New York's underperformed.
Right.
New York's underperformed by a lot, right? And I see this, and I'm kind of thinking back to our previous podcast and what the national housing market did and what New York didn't do, and it's counter-cyclical, right? So it's like now nationwide is suffering, and New York is here, right? So I mean, I look at this, and they always say don't be specific with predictions, but this, I mean, I take a look at this, and this, by the way, this is beautifully done, guys.
Thank you.
Yeah, and this channel is going to break on or before May 15th of 2027.
That's the break. That's the channel, guys. That's the channel that we're talking about. That's the break of where we probably are right now. And we're listen, we're an intelligence company. We're trying to keep you guys ahead of the curve, right? And there's a thesis here, guys. It's math, it's numbers, it's trends. And at some point, I don't know how high does that need to go for the math to start mathing, Noam?
Oh, we're nowhere near mathing. For new product, no, forget it. I don't even want to touch that, right? Well, what I do want to focus on is this, and it's you're reaching the point where replacement cost finally overwhelms price.
Replacement cost overwhelms price. Okay, and that's not conducive for building.
Not yet. I mean, if you just pencil it out, you'd have to buy something like distressed, or there has to be a subsidized component, or you have to go high end. It's just not. I actually think the environment for building is less attractive these days than it was a year ago.
Interesting.
Yeah.
Is that I'm just curious if that's a value thing. I mean, we're about to talk about policies. I'm just curious if you think is that on the political side, or that's like just a math side still?
Costs have gone up between last year and this year. I mean, look at the Iran war, oil, cost of goods, shipping goods, labor costs, insurance uncertainty. I mean, what type of person wants to take that bet? That's a scary bet. Right, to spend all of this time putting something together that doesn't pencil out. Right.
So quick question.
Yeah.
I'm sorry. No, I don't want to. John, I know you're going to go on to policies real quick, but no, in terms of supply, okay, this is going a little off track here. This spring cycle, we reached about just under 6,800 units of supply at our peak so far. I imagine it's like 6,700. I think it's going down now because we're past the spring window. The last 4 or 5 years, we were at 74, 75, 7,600 consistently. Each spring peak. This year, we're about 10% lower. Like not 5% lower, 10% lower.
So I think I forgot if it was June 1st, because I follow Macro Mondays, right? It may be June 1st. I'm not sure. Your year over year contract activity is up 5.7%. So in sort of simple terms, that means you're selling more stuff than you sold last year, but you're producing less stuff than you were producing last year, so to speak. So does that, I was sort of dovetailing into your comment.
That supply is down year over year, demand is up year over year. That's all you need to kind of know right now.
Yeah.
But my question is, how low does it go? Like, I mean, if we were at 6,700 this spring peak, and this environment that you're describing is just a continuation of the last 12 months, because you're basically saying is that this is a 2-year thesis, and we're halfway into it, and this is the part 2.
So that means that demand will be higher next year and supply will be lower.
How low? How low was, in your opinion, if we hit 6,800 this spring, what do you think we're going to hit next spring?
Oh, I remember the lowest inventory I recall, and I don't follow this as closely as you do, but the lowest inventory I recall was 2012, 2013.
Yes.
And I think the barrier was below 5,000.
It was below 3,000.
It was below, all right, there you go. It was below 3,000, right? So if you're going to sell more stuff and you're going to produce less stuff, and this time next year, how low does it go? I mean, I'm going to throw a dart. It's entirely possible that you're going to be below 5,000 next year. I don't know, but that's entirely possible.
Wow.
Just to follow up on this, because I think this relates, and you go back to the channel chart. Noah, Rick writes in, he's got a quick question. Yes. He says, looks like we're at the top of the channel. Why don't you think we're just going to bounce off the top and come back down?
Inventory.
Great question.
It's a very good question.
Yeah.
Inventory and probably rising rents.
Yeah, inventory and rents. That's the answer to the question, right? Inventory is low and rents are high. High rents create rental exhaustion and then push people from the rental market into the sales market.
You know, guys, not a lot of people make predictions and talk about these theses. Like Noam didn't have to come on here and kind of talk about this. It takes cojones to kind of get out here, put your reputation on the line and talk about things that's going to happen. Doesn't mean it's 100% going to happen. It might take a little longer, but I want you guys to think longer term with this conversation. This is not a month-to-month, quarter-to-quarter thing. Noam, you mentioned yourself, this is a tectonic shift. This is a Titanic changing its direction. It takes time for these things to play out.
I hope the Titanic changes direction because it didn't do such a great
right. You gotta spin that wheel a little faster. But basically, if you see it come down, which it could come down, that might represent April's print. It may not really represent May or June or where we are right now. It might take another couple of months. Like I said, if you want to know where we are today, right now, in terms of a deal you signed yesterday for real-time market, you got to wait till September, October to get those prints. And that will reflect today's market. So keep in mind that sales data is always 3 to 4 months kind of rear view mirror looking back. But generally speaking, with this chart, it looks like the pressure cooker is just on, because if you follow the rents and you see what's going on there, how does that not drive renter psychology to consider buying and on a mass level? Like we just showed that video, just inevitable.
Yeah, it's they're gonna get pushed into it, and then if you really sort of dissect the tax benefits and owning versus renting, and you ask yourself a question, well, I made all this money in the stock market, maybe I should take some chips off the table. I'll go into real estate. Real estate's going to be a little bit. We need some FOMO.
Out.
It's coming. It's coming.
It doesn't exist now in any way. No one believes it. It's crazy. The mindset of people in the market is not thinking like this. They're not looking at it. All they're thinking about is the last 10 years and how it's done nothing and that it's just exhausting. And they're not really looking the next 10 years. They're looking at what's happened. It's just a strange thing happening out there.
Well, the other thing is, FOMO could also apply. You could also take those letters. It could be fear of more obligations, which kind of leads me into the next section, which is policy, right? I mean, we've had the changes in policy over the last year since we've done this have been, I think from the headline, they've been somewhat profound, but I'm just curious, you think about, Jonathan Miller recently did an interview. Jonathan Miller, master appraiser, master of the universe, he is the man. Basically noted that there's, as you said, there's vulnerability in the lower half of the market. And I'm just curious how, when you think about the channels, you think about that lower half, you think about those policies we've seen come in, what's your take so far, Noam?
Okay, so the 2 comments to the Jonathan Miller podcast. And by the way, yes, he is the master of the universe. But I do respectfully disagree with him on one of the comments that he made. So he says, not as an investment, right? And, I only look at it as sort of buying a home because I want to be able to do what I want in my home. And this is why I buy, which is a very fair point. But I think that if you're looking at the younger generation or the generation that's going to be purchasing and participating in this marketplace, I don't think that they differentiate between a home and an investment. I think that this next generation says, I have this money in the market, it's working for me, and now I'm going to buy a home because, I'm going to transition from this bucket of investments to this bucket of investments. That's sort of a psychology thing. You mentioned one other thing that he brought up, but forgive me, I lost my train of thought there for a second, John.
Well, it's the idea that market is vulnerable, right? So we're sort of
yes. So that vulnerability is a two-way street, right? So you could be in a scenario where the under $3 million market is vulnerable because you need to access the lending market, which is slightly restrictive at the moment, right? But that vulnerability means that portion of the market could be eaten up faster.
You have a note here in our questions. If you, instead of spending $5 million on one condo, you could buy 2 at $2.5 million each and throw a $250,000 mortgage on each of them. I now just avoided both taxes and constrained supply further.
Okay.
Elaborate on that.
Okay. So that's the Pied-à-Terre policy that I think you were referencing, John. Is that correct?
Correct.
Okay. So Pied-à-Terre, which is sort of like a new piece of the recipe now, because that didn't exist 12 months ago when we spoke. I think this only reinforces the inventory problem and the breaking the channel thesis that we have here now, right? Because if because the Pied-à-Terre tax, you get taxed a certain amount at this level, a certain amount at this. I think a $5 million and above is sort of like a headline news. But if you dissect it a little bit, there are different tiers of taxes depending on the level of real estate that you buy, right? So it motivates you to buy at the lower tier, right? So the person that's buying at 5 million maybe is going to buy at 4 million. The person at 4 million is going to buy at 3, or instead of buying one condo at 5, maybe you buy 2 condos at 2.5 each, right? So the wealthy person is almost crowding out the people below them. It's a little nuanced, but it's not helping the inventory problem. It's hurting it worse.
Policy is creating urgency, both rental policy and new taxes. Could you just explain that real quick? Okay,
so policy is creating urgency. The urgency is you need a place to live. So that's just a fact. So now you're in a scenario where it's almost like it's inelastic demand, right? You're not going to negotiate with Con Ed, and you're in a position where your ability to negotiate and procure housing at under $5 million is becoming not a non-negotiable, right? And that you might as well just lock it in now, even if you don't think you're getting the best deal possible, because you need a place to live. that's the urgency, right? If you go back to that 800 Fifth Avenue reference, right? All those people are getting vacated because new housing is being produced. Now they have to find a place to live if they want to remain in New York City. And a lot of people are staying, right? I mean, so you have, a little bit of this drama in the media where people are leaving New York, but people live in New York. They function in New York, right? And now they have to find a place to live. So their ability to negotiate is limited. And there's your urgency. And it's, a lot of it is policy driven.
It's really interesting. Earlier on, you mentioned that volume does not equal price. And if I step outside of the channel, so if we're no longer talking about individual units and price and volume, but if we shift the focus of the conversation more to the industry, if we're talking about less stuff coming on the market, less movement, less transactions, and prices going up, what does that mean for the real estate industry writ large? Who are the winners? Who are the losers? How do you prepare for that?
I think this goes into sort of any career advice that you would go into. I think you have to find your niche. You have to find whatever your specialty, your expertise is, because I think just trading is going to be lower for the foreseeable future. So you have to focus on what your strengths are and sort of cater to that, depending on who your client base is. But your ability to advise and guide and say, this is, according to, whether it's this podcast or other reports that you read or whatever it is, communicate this information, because it'll help you at least prepare yourself, prepare your client. Because if it doesn't happen, if my prediction is wrong, then your consumer has more options. If my prediction is right, your consumer has less options.
Okay, guys, this is your last call for questions over here, by the way. We got one or two more questions here for Noam. There's a list of questions we asked you last year. I might actually ask you them again quickly this year, just to see if anything's changed. But I want to just try to summarize this, where we're at over here. So the next year or so is a continuation of shrinking inventory in the sales market, low volume in the sales market, prices starting to break the channel on the sales market for the first time in a decade or so. At the same time, rents continue to rise. Commercial rents continue to rise. And we're going to enter an era of sales market seeing prices rise with those rising rents, but not volume is not going to rise. Still going to be a lower volume situation because we have lower supply, and it's just going to be a tight, again, 2012, 13 kind of comes to mind in terms of market cycles. And then after that, as that plays out a little while, now you're in 27, 28, the math might start mathing a little bit for developers to think about permitting and putting some new investments in play. Right. And then that's going to take 4 or 5 years to come out. So my question in all this is when does the volume come back? Are we in this lower volume era for another 5 years, I guess, until after that new development cycle?
For the foreseeable future. There's too many variables involved in that question, right? And you also have to figure out how well the market is going to perform over the next 2 years, right? Is it going to go up 1%, 3%, 5%, 10%? Where is this pressure taking us? And time will tell, right? And it's time's ticking. It's gonna happen pretty soon. But are the prices going to go up enough, and the cost of capital and the cost to produce housing going to go down enough where there's going to be equilibrium there? That question, that's a very difficult question to answer.
Okay. Right. And guys, speaking of, I just want to get to a couple of questions we have in the comments. And the first one is from Deborah. And I think this is sort of on the professional side. So if we're talking about the idea, and this is sort of the thesis, right? And we're talking with a group of professionals here. This is not really, us talking to clients right now. But, Deborah's question is, do we advise not to sell out for a year if we think prices are going up? And I think the larger question to me from that is, assuming that we're all in agreement here, this is kind of the way the tea leaves are pointing. how do you, or how would you know, and put this in a conversation with someone who is considering selling now or considering waiting? How would you frame this conversation?
So if you're selling now, your opportunity to purchase something, let's leave mortgage rates out of it, because if you're selling now, there's a high likelihood that you've owned it for a long time and you've accumulated a certain amount of equity and you've done well in the stock market and other things like that, right? So you're essentially a prepared seller, right? Which means that your ability to negotiate a good deal on the other side is very favorable, right? Because you're a prepared seller. That will begin to become more challenging in the next 12 months and on and on and on, right? Because the prices are going to start fragmenting a little bit, right? So if you're going from a 1-bedroom to a 2-bedroom, for example, right, your ability to make a lateral move is easier now. Next year is going to be more difficult, right? So it's a very sort of nuanced, very personal finance related question, right? Because it's very consumer driven.
Because the larger apartments, higher price points are going to probably outperform the lower ones basically through this cycle.
Right.
Interesting.
All right.
One more question. What about the co-op sales market? Can you please comment on it? I just happened to pull up on UrbanDigs co-op liquidity. You know, co-ops made a really nice comeback. This whole market just really activity-wise just really went into high gear over the last couple of months. But the co-op market specifically, March and April has a nice recovery. And the last couple of months, we're just sitting at this camping out. We put a tent up and we're camping out at this higher level of deal activity in the co-op sector. I just don't know if it's translating to all co-ops, because you got those co-ops that haven't been renovated in 25 years that are low floor, high maintenance, whatever. I don't know if those kind of guys are joining the party, but the co-op market in general is doing okay. Noam, any thoughts on the co-op market?
I don't participate heavily in analyzing the co-op market, but okay. It's an end user product, right? So you are buying an apartment to live in, right? So I think it's certainly going to attach itself to this uptrend because it is inventory in the marketplace, and if inventory is thin, then co-ops are going to benefit from that.
Right. All right. Let's wrap this up. Yeah, that's a really good point. I want to just ask you, Noam, to summarize this investment thesis overall, you know, for those people that joined a minute ago, maybe, but wrap this all up. I know New York City is notorious for not producing any yield, but it's very, very good for wealth preservation. But just in your own words, to summarize what's going on with the New York City investment thesis, just to close us all out. And then we're going to ask final questions from you guys. And I got a couple of questions here I might ask you, and then we'll call it a day.
Okay. So thesis from last year to this year is rents are going to go up. They did. They will continue to grow up, to go up, but not as aggressively as they did. Consumer mindset is going to get exhausted. It's going to be like, enough of these rents. That's it. I'm going to buy something. It just pencils out, and it makes a little bit more sense to put a down payment down and maybe buy something. That narrative, and that is where we are. We're in this period of transition of going from where we have been for the last 10 years, and we're going into a completely new market cycle, right? So we're starting again, so to speak. If you want me to summarize it even less than that, let's see, what else can I add to this? The ability to produce housing in the under $5 million bracket is extremely, extremely difficult. So I would focus on that as the reason why inventory is going to go down.
Yeah, you have a note here. If you're a buyer today, move your ass.
Move your ass. Yeah. All right. You're not going to get a better deal. I don't, you know.
If you have buyers out there, send them this interview. If you have buyers out there, let them know what this thesis is all about. And remember, guys, we're not just pulling this out of our behinds over here. This is something we've been talking about a year ago. Look what's happened. And we're talking about it today. And we're math formula. Go ahead, John.
Well, I was going to say, I just want to play devil's advocate, Noam, and just talk about what has to happen for prices not to move from here.
Oh, that's a good question.
That's a good question. Black swan events in the financial markets, right? You know, things that create a tremendous amount of uncertainty.
Credit spreads widening.
Credit spreads widening. Things that scare people as a whole, a pandemic, if you will, right? But barring those sort of like large, abrupt moves, how could this not happen? I just don't see how it couldn't happen.
Yeah, it's interesting because it's the point you're making is that this is sort of baked in structurally to the market right now.
Right.
And when you talk about black swan events, we talked earlier about how rates are sort of separate to this whole conversation. We're sort of in a stable rate regime, which is it's neutral one way or the other. But if you have like the great financial crisis or something like that, we have credit spreads blow out, mortgages stop being written, banks are failing, dogs and cats living together, the whole works. Like that does intrude on things, and that I suppose that could derail it. But aside from that, it's like this. It's like a locomotive, like it's on a railroad track. It's going to take a lot for that train to get off the track. It's just it's not going fast. It's just pushing ahead very slow.
You're gonna have to challenge 10 years of pressure. That's very hard to do.
That's the thing. Like if you look at what the other markets did over the last 10 years, a lot of markets are going down in the national housing market, but they've went up 150%, and now they're down 20.
Well, I would say we're almost seeing ahead of the curve because of what we're seeing in Brooklyn. We've seen like the volume in Brooklyn has been kind of low, but prices have kind of gone sideways. Sure, you can find some pockets where prices have decreased, but other than that, like Brooklyn prices are remaining somewhat stable. So it's it's a microcosm of what happens even in that volume declining market. We just don't have the supply. The supply in Brooklyn's been really, really tight, and it's creating these frenzied bidding wars here and there, but sort of a sign of things to come, perhaps.
I completely agree. Anecdotally, if you follow certain buildings, right, and you see a unit that's come on the market and off the market and on the market and off the market of last couple of years, there's certain buildings that I follow, and those units are now in contract and they're selling, right? And that's if you follow certain buildings, I'm sure a real estate professional will see the exact same thing.
Yeah, I think a lot of agents do see it's resonating what we're talking about here, but you have to understand if you're a real estate agent and you're in it and you're dealing with the everyday emotions of buyers and sellers and the everyday complexities of doing deals, it's hard to take yourself out and look at it from a 10-year window perspective like we're talking about today. So that's why I love this. All right, listen, we're going to do speed round. Now this speed round is questions from last year.
Okay.
I don't have questions from this year, but you know what? I'm curious. They're really good questions, and they're all pertinent. If you guys have questions, this is your last 10 minutes. Okay, John, you see this document with speed round, right? We'll rotate. Do you see this?
I do not see it, but I will.
Take a look. Scroll down that document that we have of questions. Did you ever see there? And Noam, short answers. Speed round. Okay. Buyer's market or seller's market right now?
It's deadlocked.
It's neutral. Okay, you said the same thing last year, so we're still kind of neutral.
Yeah.
Stronger force, rates or inventory?
Inventory for sure.
Said the same thing last year. John, do you want to join in here on questions, or you want me to?
I wish I had the question list. I don't have it.
You guys see what I'm saying?
I had one job.
Who brought this guy? All right.
That's as far as I get today.
You look great. Are we in a normal cycle or something structurally different?
Structurally different.
Oh, because you were approaching normal last time. Now it's getting structurally different. Interesting. Forward outlook, better market in 6 months or 18 months?
Better market in 18 months, right? It just gives you more time for this to metastasize, if you will.
Yeah, I like that word. You said the same thing last time. Will transaction volume rise this year?
No.
Okay. 2027 prices, higher, lower, or flat?
Higher.
So interesting because last year you said flat. And that's exactly what happened. It didn't do it. You're like, it's too early. I remember you said that. You're like, it's too early. It's going to be flat, then it's going to go up. Now you change to higher. Guys, listen to what he's saying. Biggest seller mistake?
Biggest seller mistake. That's a good one.
I know I'm putting you on the spot.
Yeah, no, this is don't expect to walk into the market that you have been functioning in, if that makes sense. So the seller's expecting X to happen, and now things are going to your ability to maneuver in this market, or the way you're maneuvering in this market has changed. That's a little nuanced.
It's okay. I'll tell you what the biggest seller mistake in my mind is that they are overestimating what their renovation that they did 10 years ago is worth.
That is 100%. That is a factual statement.
Huge knowledge gap. It's crazy. We're doing these reports and I'm going on with these sellers. They did renovations 13 years ago. They want to get everything back. They just don't, because it looks great. They don't understand that buyers are they're bidding differently. They don't get it. Biggest buyer mistake.
Biggest buyer mistake. Too much emotion, maybe. I don't really. Yeah.
If you were a buyer right now, would you be buying?
If I was a buyer right now, would I be buying? Yes, I would. Yes, I would, because I'm gonna get a better deal this year than I will next year.
Okay. Inventory, temporary or long-term problem?
Long-term problem.
That's a key, guys. That's a key element. You said the same thing over there.
Well, I'm going to interrupt you. No, I just got a quick. So if you have inventory as a long-term problem, that sort of means supply issues, lower volume, et cetera. Is that going to force brokerage consolidation on the industry side?
I think it will.
It's already happening.
Yeah. I mean,
that's true.
A lot of different forces are doing that, but for sure.
Yeah. I mean, the Real Agency bought Realty Max. I mean, that was like Realty Max. Like, oh my God. And the Compass is just, crazy expanding. Will New York City ever meaningfully fix the housing shortage?
You want my honest answer?
I always honest answer. I don't care that if it's not palatable. I don't care on this show. You know what I'm saying?
No.
God,
It's the machine.
Frustrating.
The machine is broken.
All right. Is it better to rent or to buy today?
Personal finance question.
What's that?
It's a personal finance question.
Okay.
Right. This goes right.
Do rents push people to buy, or do they keep them stuck renting?
I think rents push people to buy. Right. If we're really dissecting this entire podcast, yeah.
And the final speed round question is Brooklyn or Manhattan over the next 2 years? Which market will outperform?
Brooklyn or Manhattan over the next 2 years. I think Manhattan will outperform Brooklyn because there's more of it.
Interesting. Guys, that's it. That's it. I thought it was great stuff. Thank you, Rick, for saying great stuff over there. I think this is just super interesting. And again, guys, if you heard what he said a year ago and you pass this on to your clients, you're looking like a rock star today. It's all about advisorship, independence, neutrality. And I love bringing on these independent experts to talk about the market and up all of our games in terms of intelligence. So Noam, with that, thank you. Thank you for coming on this show and sharing your thoughts. Guys, Noam Newman, do you have an email, Noam, that people could say thank you or send an email out to? Or do you want to put it in here?
It's Noam Newman at mac.com.
Okay,
if you want to reach out and chat about this stuff, or if I can.
We'll put all your contact info and your personal address and cell phone number. We'll put it in the YouTube just so the world can reach out and say hi to you.
Is it okay if I share if I share your email? Is it okay if I share your email in chat?
Sure, that's fine.
Okay, guys. I'm putting Noam Newman's in there in case you want to reach out to him. He's super smart, great guy, CRE owner and developer. And again, this is what it's all about. I think it's a great thesis. I completely buy into this thesis. You hear me talking about on UrbanDigs all the time. Guys, I think this is in play. You are early. We are in the batter's box and the game didn't even start yet. That's how early we are. This is going to be years. Okay, guys, think about it. Let your buyers know. It might expedite their decision in a positive way, in my opinion. But outside of that, Noam Newman, thank you so much. Johnny Walkup, thank you so much. I am Noah Rosenblatt. We're both at UrbanDigs. Thank you guys for joining, and we'll catch you guys next time. Cheers, everybody.
Thank you, everybody.